You know, he is an extraordinary observer of what's been going on and seeing trends and trends that are happening. But more than just that, what Tony is great at is when he sees these opportunities, he actually does something about it. So way back in the beginning, you know, Tony, when he saw the emergence of Silicon Valley, young guy out of college, joins Silicon Valley Bank, right? You know, which was a prescient insight into sort of future trends.
Actually, I had a rich father-in-law who became their largest investor, so they had to hire me. But I did a few deals when I was there.
A few deals. Make up for it. Right,
Jim.
So you know, and then I actually, as Tony said, I got to know Tony when, way back when. There was a guy around here named Ed Schau, who was a congressman, and you know, a group of us back then we were young bucks, and you know, in this new emerging Silicon Valley, and we were sort of working for Ed Schau. And when the campaign was over, Tony and Rich Karlgaard and a few other people were sitting around saying, you know, this has been so much fun, we'd hate to let it end. And so Tony and Rich said, let's start a club. And Tony's brother said, let's call it the Churchill Club. And so we all got together and we started the Churchill Club way back then. And then Tony and Rich said, you know, there's got to be something like you know, now that desktop publishing is possible, we could start our own magazine about the emerging high technology world. And so Tony and Rich start Upside Magazine. And then, you know, a few years after that, Tony said there's got to be something that, you know, sort of deeper into the finance world of Silicon Valley as this bubble is emerging. So Tony started Red Herring and sort of added a couple of other things on top of that. And then in 1998, Tony said, oh crap, you know, looks like we're forming a bubble here. So Tony and his brother, in 1998, write a book called The Internet Bubble.
The fact is that when the book finally hit the bookshelf, because we wrote it from June 98 to June or July 99, then the book came out on October 1st. The NASDAQ was a low of 3,500 or 3,800. And then we said, hey, if you own any of these 217 internet stocks in the back of the book, you know, sell now. But then in the next 6 months, the NASDAQ went from 3,800 to 5,500. So we were looking like assholes. We didn't know what we were talking about. But the good news is during that period, there was so much tension that our book was selling like hotcakes and became like an international bestseller. And then we looked like we were wrong. But then when the NASDAQ was at 1,100, then
you were geniuses.
Yeah, we were geniuses.
You were geniuses.
People forget the first 6 months I wasn't looking too good.
Yeah, well, so the bubble bursts, and Tony says, wait a second, you know, it ain't over. There's all sorts of interesting ways to connect in this new world of the internet. So he launches this company called Always On, which was predicated on this sort of opportunity to create a community blog around emerging technology companies. And so in that sense, you know, at the front end of the whole blog universe, layering on some events on top of it, and now, wait, there's more. Tony is about to launch the next generation of Always On. So with that, I'm going to let Tony tell you a little bit more about his current observations and what he wants to do to capitalize on them, and then how they might be relevant to all of you as you're mapping out your strategies going forward. So with that, Tony.
Groovy. Thank you so much, Bill. And Bill is one of the great friends over the years, so that's part of what's wonderful about being here, because you're originally from back east, right?
Well,
so Chicago,
back east, right?
Refugee. So the beautiful thing about having grown up here is that you know, I could not live anywhere else, because it all, like they say, all the loose marbles roll west. So, like as exhibited here in this room. So I know you're all loose marbles, but that makes for an entertaining life, right? So since I'm not being paid, I did get free lunch, I insist that you all go to AO Network right now and sign up as a member on your cell phones. No, I'm just teasing. But I told K1 I would do that. But what I'm going to talk about, because I'm not that narcissistic, I want to kind of play both editor as well as pitchman. And basically what I'm going to tell you about is where I think the opportunities, some cool opportunities to build really big companies are, and then kind of slip in how I am trying to take advantage of where I think those opportunities are. So as an editor, I love this quote from Ev Williams, because basically when I look at any new startup, and I'll say one caveat of this, but I think a good metric is to look at it and say, what value is that internet providing? And as Ev Williams, the co-founder of Twitter, says, is that if you can identify something that people already do, and I think a great example is Uber, where people need to get a ride to the airport. So Travis over at Uber, put it on the internet with a mobile, really, with a great interface, and he has created a multi-billion-dollar company in the last 4 years by creating a service that saves people a ton of steps to do something. So whatever you're pursuing or whatever you're looking at, this is a good metric, is what this offering, this internet service is delivering. Is it going to save substantially people's time? Now there's another side of that, because another one of my views is that there are two kinds of internet sites. There's ones that save you time and the other ones where you waste time. Okay, and waste time is a good thing, but that's a harder business to be in, because they're in essence in the entertainment business, and that is more subject to fashion going in and out of fashion. So that's one of my first principles I'd like to share to help you exercise your brains now that all the blood's gone to your stomachs for having lunch here. The other one is, this is Jim Breyer. I've known him forever, since I was at Silicon Valley Bank. He was the first institutional investor in Facebook, as sits on their board. He has now, Excel Partners has office, well, they're investing in Australia, but obviously are in China. Now, he is saying that 50% of the VC returns will come from investments from outside the United States. And by the way, I've asked Bill to interrupt me anytime that he wants.
So, well, I wanted to complete the statement, but do you really believe that that's true? I mean, either what he's saying is the rest of the world is all of a sudden going to grow so much faster than Silicon Valley in the U.S., or that Silicon Valley in the U.S. is somehow going to collapse such that the rest of the world becomes 50% of the returns. What is he really saying, and do you believe it?
Well, let me do a poll. How many of you were born outside the United States? Is that 50%?
How many of you are here now?
Okay, I'm a Silicon Valley kid, man. I believe we will rock and we will be the center of the universe for a long time. I think 60% of all the cool stuff's going to come out of Silicon Valley. So I believe in globalization, but you caught me. I don't necessarily agree exactly with this, but I think that it is a good illustration of globalization. But I'll get back to that, because I'm going to help facilitate and make this happen. Okay? But very good point. I'm going to get to that. Okay, we'll get back to that. Part of privilege of being me is that when Mark Zuckerberg showed up in town, he contacted me, and he was just here for the summer. Okay, and he was living in a little house in Palo Alto, distinguished by having a zip line that went over the pool. But it was one that you would never want to let go of, because there are a bunch of beer broken bottles at the bottom of the pool. And I'll talk about that at the end, because he gave, I'm a big Mark Zuckerberg fan. But what was interesting is when Sand Hill Road, which is getting more famous for having Russian hookers than venture capitalists, but Sand Hill Road, Rosewood, or the Hosewood, Am I being impolite, Bill? He's so preppy. Don't want to make him sweat. So where they're saying is, oh, social media, there's already enough sites, et cetera, it's fun to, the entrepreneurs always say, oh, are you kidding? And here's the king of social networks. He's saying, no, there's going to be many opportunities to come. So, I don't know if you feel that's unconventional, but this is another premise that I'm working under. So why? Because pure and simple, this is a really interesting chart, but what this shows is that the old media sites, okay, like TechCrunch and Yahoo and CNN, they, over now 3 years ago, have less viewer time than the socialized sites. Okay, so when I first came up with this slide back in 6/12, okay, either Facebook and Twitter were going to take over the world and we just wake up every morning and go on Facebook and Twitter, or there would be other social networks to play with. And I, of course, believe what Mark Zuckerberg believes.
Wait. So you're saying, I'm sorry, first of all, you're calling Yahoo and TechCrunch old media?
Yes.
Okay. So that's kind of novel. God bless you. Okay.
Okay, well,
so what's your distinction?
Well, I'm glad that you asked that, Bill, because what do people do on the sites? What do they do now? Why? Okay, so when you guys go to TechCrunch and I go to TechCrunch, we see the same thing. I don't see you. I don't see anybody. The only interaction I have is I can maybe make a comment on an article, but it's the same chase traffic. In order to get traffic, be snarky, sell the stuff at really low margins. It's a really low margin, low growth, very interactive, old-fashioned business. So
you're saying, you're not even talking about the Wall Street Journal. You're saying TechCrunch is old and is dying. That's what you're saying?
I think that it's going to get eclipsed by Always On, but amongst other people. But I think that, again, I would say more than TechCrunch. I mean, my joke is that Don Graham sold the Washington Post to Jeff Bezos for $250 million last year because he didn't want to sell it to him for $10 million this year. Okay, so I think New York Times, Washington Post, TechCrunch, they're getting crunched. So, and again, statistically is because the young generation who, if you're going to build a company, you got to build it on top of the young generation, okay? They want, when they go to a site, they want to have power. They want to be able to connect, they want to be able to see, they want to be able to interact, and if you can't, and they want to personalize it, and if they can't do any of that stuff, they're not going to go to your site. I mean, that's just the facts, okay, as far as I'm concerned.
What's the political scale on that thing? I didn't quite catch it.
Okay, on which? On this one?
The scale
on the bar chart.
Okay, so I'm sorry, so this is years, and this is the time spent on these sites.
So the next chart, the next slide is...
Sorry.
Right.
Okay, up here on the right. I stole this slide, so I'm not sure.
It's daily time.
It's
the amount of time spent each day on different
things. So basically, socializing online is the number one thing. Yes, young man.
So you were saying that all the TechCrunch, Washington Post, you don't believe in it anymore. Therefore, there is Reddit became like a social approach. What do you think about it?
What do I think about Reddit? I don't know much. I mean, I know Reddit. I don't really use it. I think that you still have to have an imaginative strategy. You just can't throw up any old social network. But what I'm saying is that in terms of destinations, the people are clearly voting to go places where they can, do more than just be fed the same information that their neighbor is, pure and simple. So
another question?
What about convergence?
Well, yeah, again, I think, again, my metric is whatever your brand is, it needs to represent helping people do something. Okay, either get shit done or entertain themselves. Those are the only two things that you can do. Okay, and they've got to be able, my good friend here, Oliver, Fluidity, I'm a believer in his company because he is putting together a platform to make your ability to manage overseas manufacturing as a small business happen more transparently, more efficiently, and save you a bunch of time and stress. Okay, so that fits this equation. Okay.
So, and Tony, though, you would agree, I mean, so Reddit may be an example of this, where there's a get stuff done aspect to it. In other words,
Right.
I want to find useful or interesting news, but there's an entertainment component in that it gives you, sort of the serendipity of discovering stuff that other people have discovered that they think. So there's the social serendipity component of it, as well as the I want to acquire interesting information. I don't know. Is that how you use Reddit?
I don't use Reddit.
Oh. Okay. But there's a convergence aspect to it in the sense that you're bringing together a social component with a practical or useful component.
Now, I do believe in simplicity, even though what I'm going to do is not so simple, but it is simple in design. But you got to be careful. You got to have a purpose that's very clear to your audience, that you won't get an audience. Okay, so in my business, I think this is, the king of VCs. Mike Moritz funded at Yahoo, Google, sits on the board of Google, whatnot. Brilliant guy. He's always said, who you know, what you know, and when you know it is the currency of the global Silicon Valley. So we're all here, okay, to get in, gather information faster than if you're sitting out in the parking lot, right? So that is the essence of the competitive nature. That is why half this room is from another country, because you all are here to get in. Because if you're sitting in Taiwan, you're missing out, right? So that's why you come here. Okay.
So Tony.
Yes, sir.
So in your tagline for the new Always On is the global Silicon Valley, right? And that you're shame on me, I should know what your tagline is. But so you talk about the global Silicon Valley, right? Powering the global Silicon Valley. So you talk, and I totally get this globalization. I mean, that was an astonishing show of hands. I totally get this globalization thing. So when you say the global Silicon Valley, what do you mean? Do you mean, is it that everybody's coming here and so it's international? Do you mean that Silicon Valley is expanding globally? And so what do you mean when you say the global Silicon Valley?
That's a very good question, and probably one of our communication challenges. But I will tell you what that means. First of all, I think we would all agree that while Silicon Valley is the Athens of the information age, i.e. the center of the entrepreneurial world, there for 20, 30 years now have been mini Silicon Valleys being formed. Started in Boston and Austin and North Carolina and Seattle, and then it's been spreading all over the globe. And what's unique about all these regions is the mentality and the comfortableness that they have with getting behind ideas and the belief that they may possibly grow to very large companies. And so I have been for years trying to figure out, how do you describe that global community? So hold that challenge, and then rewind to Silicon Valley Bank. When I was there, when we opened the door and co-founded the tech group at like 23 years old, one of the the visions that we had at Silicon Valley Bank, which spinning forward is now a $30 billion global brand, okay, all over the world. In those days, we were thinking just about, hey, can we set up in Austin? Can we set up in Boston? Will this name Silicon Valley Bank work against us? And the fact of the matter is, that was the best thing that ever happened to that company, because no matter where they went, everybody knew exactly what they did. Okay, so based upon my challenge of wanting to come up with a name and the success of the Silicon Valley Bank brand, I came up with that. So does any of you lovely people from out of the country offended by my expression? Okay, good. All right, but that's a good question. Okay, so when I started Red Herring magazine, no one was covering the business of technology, right? And so our market, believe it or not, was undercovered. Now the problem is there's too much noise in the market, and for you that are over 40, I know you'll have a hard time to read this, but this says infobesity, okay, which is a phrase I stole from Alan Toffler, which just means too much information, right? So, the new Always On 2.0. So, like Bill very well pointed out, when I first got started Always On back in 2003, that was the beginning of the bloggers movement, and the bloggers movement was driven by WordPress and Blogger and basically cut and paste publishing. So most of you in this room are too young to remember that, but in the old days when the web first came out, you need some serious HTML programmers to post on the web. And then this whole generation of platforms came out and made cut and paste publishing really easy. And so that was Always On 1.0. That was just saying, hey, we're going to use this cut and paste publishing and we're going to create super blogs. And after us came the TechCrunches and the GigaOms and the VentureBeats and the Huffington Post and all that, because it was based upon those same models. Okay, so why didn't Always On become the TechCrunch of the last 10 years? That's a good question. Because it's a shitty business. No, it actually, I give Mike Arrington a lot of credit. I consider him a friend. He thought of starting the company at one of my events back in 2005. So he gives me credit for that. But what people don't realize is that their revenues never got above $3 or $4 million bucks. Okay, so they may have been the best. I mean, I'm talking about online advertising revenues. So like all of us in this era, we all made money producing events. Okay, so, but I saw through Always On by producing events, that's how I met Mark Zuckerberg. I met Reid Hoffman when he was founding LinkedIn. I met, the original guy was Jonathan Abrams, who founded Friendster. And Mark Zuckerberg has told me there would be no Facebook if there hadn't been a Friendster. Friendster was the first true social network where you could actually start seeing all your friends on a network and connecting with them. So what I'm proposing is we, for 10 years, have produced private growth company events. So we have On Media in New York, On Hollywood down in LA. We produce 6 events that bring together private companies that are screened and filtered, largely already venture-backed, with the companies like HP, Oracle, Disney, wherever we are, the strategic partners, and obviously the investment community. What I've launched 2 months ago is I've completely redone Always On Online into a social network that aspires to connect every entrepreneur and investor and person on the planet so that next year there'll only be 10% from outside the country because no one will have to come here anymore because they'll just go on Always On. As we build this community by the end of the year and at the beginning of next year, we're going to start a crowdfunding platform as an extension to our network and match global investors with hot companies spinning out of this market. So I'll get back into that. So in essence, we are taking a technology platform and applying it to the business of the global Silicon Valley, okay, to get things done more quickly so that you can find, filter, and access top companies, investors, and partners more quickly all over the planet. There's a reason to believe in this dream because there are other platforms that, in their own way, Facebook, some people market Silicon Valley companies on Facebook, particularly consumer brands. LinkedIn is kind of a good way to do human resources and find talent. And then, of course, AngelList has a platform that is trying to socialize, which has socialized much of the angel investing market. But of course, all the other brands are old media, so they don't offer any of that other stuff. So I think that there's this amazing opportunity. So let me ask you a question. What site can you join that where you could join the global Silicon Valley? Okay, but other than always on. When you're on LinkedIn, are you part of the global Silicon Valley? Does that help you find and connect with companies and investors and organize your business? Okay, so that's my proposition. So what does it look like? Well, I've got the original art director from Rolling Stones, Roger Black, who's one of my dear friends, who used to do speedballs with Belushi, as my art director. Spinning forward, he's a famous guy who I get a big discount for, and that's why I think this looks beautiful. But he has done Bloomberg's mobile recently, devised. He did Sporting News' iPad app, and he just redesigned Scientific American magazine. So what's different, what I believe, and this is a big, softball to media entrepreneurs, that I believe that in the future, the social networks that will be successful will follow our model, which is lead with a landing page that is a media brand, okay? But you'll notice up here you have Always On, which is our stuff, then you have Popular, and then you have My News and Power News. What do those mean? Well, within Always On, every person gets a much better looking and cooler profile than you get on a LinkedIn, plus you get a blog, okay? Companies that have been approved by us, and we've approved 28,000 companies globally, get invited to have a much more useful and beautiful profile than you see on Crunchbase with analytics, okay?
So Tony, if I got a startup company and I don't necessarily want my analytics shown,
Right.
do I can suppress that until my analytics look good?
It's a free market, babe. No, one of the interesting things about the new generation is they don't believe in privacy. In fact, we don't have a privacy policy. It's like whatever you put up here is what you get. And we're actually uploading capitalization structures right now, and we're not going to let people touch their capitalization structure. So we're going to stay in control of the information, the financial information that we believe that no one would normally give us. Okay?
So how many entrepreneurs here want to publish, how much stock you have, what your revenues are this year, what your loss was this year, and how much investment you've raised?
Okay, well,
right?
Okay, but out of all of those things, the only thing that we're really going to show is the money you've raised, which is the same thing that Crunchbase does.
Okay.
Okay, now there is another room that you'll be able to do something different in.
Okay.
So back to this, this is really important for entrepreneurs to think about. Okay, yes, sir. Gust is very cool, but I would say that has two faces to Gust. One is it's an angel fund crowdfunding thing, and it's also a way for investors to manage their portfolios and other things. So it has more of a SaaS platform for investors. But really, this is one of the biggest points, is that the companies that are going to do well in the media business are the ones that get the community to provide most of the information. Okay? This is why Reed has built a $30 billion company. So how do we do that? Well, we're going to have our original content. So I believe in staying a media guy, because media people like media people because they want to be written about on our site. So they're nice, and that makes them pay attention to us, right? But really, 99% of the content will be the profiles and blogs of the companies, people, and investors, all the activity. You'll be able to, in essence, go in and, if you want to track Tony Perkins, you click on that, and then you can connect to me. For individuals, I have to approve, but for a company, you can track Always On. This is supposed to be a Greylock thing. I don't know why this didn't show up, but pretend this says Greylock. Then you can track Greylock. And so when you go back to your personal news, you hit My News, and it's your Facebook for the global Silicon Valley. So if you're a VC, you want to track all your portfolio companies, all their competitors. This is a personalized newspaper to the people that you're connected to, the companies and the investors that you care about.
How accurate are you going to be with this data? Looks like your picture is 2 years old.
I know. Well, I've updated that. That's actually from That's actually a highly stylized high school shot.
For those of you who did not hear the question had to do with the accuracy of the data on Always On, given that Tony's picture was clearly false advertising.
Okay, come on. I deserve that. Okay, the quick answer is I don't like to have my picture taken. Then the business model, which is the thing I've struggled with, is that we're going to be mapping the activity of the global Silicon Valley. We're going to understand what you read, what companies you track, what you care about, who you're connected to, and we're going to, if for like LinkedIn, you can pay different amounts of levels to have more connection power, more search power, more filtering power, and more data downloading power, all sorts of stuff like that. So this is just a play right out of the LinkedIn playbook. Okay. Let's see, where am I? Okay, so what's interesting, this is the amount of new users to LinkedIn, and this is their gross margin. So what's interesting about this is the more members they get, the higher their gross margin gets. I mean, this is the best business model in Silicon Valley right now. So buy LinkedIn stock, buy Facebook stock, buy Yelp, get Uber when it comes off the IPO line. This is a great model, which I admire. Okay, now to the crowdfunding. I've gone back to my friends at Silicon Valley Bank. Very interesting. They claim, and anytime that somebody uses $1 trillion, I kind of roll my eyes, but they claim there's $500 billion of money around the world that wants to come into global Silicon Valley style companies, okay? But on Sand Hill Road, other than going to the Rosewood, they don't want to talk to anybody. They are an old boy network that's just trying to keep the supply of capital down, keep a manual hold on their deal flow, and keep valuations low, okay? So that's ripe to be picked off, okay? So what I'm proposing is after I get the social network up and humming, and we have a brand and a reputation that's kicking butt, we have a history in the last 10 years of picking top companies. So you've probably heard of the On Media 100, the Always On Global 250. Well, Morgan Stanley and 451 Group analyze all the companies we've ever picked every year at our summit, and basically we're batting, I think, 50%. Right now it shows that out of 1,100 companies, 27% got acquired at multiples of 4 times the median, plus IPOs of, which is getting to be a bigger percentage. There's still a bunch of companies that are alive. So I think we've picked 50%. Those are the companies we're going to invite onto our social, or on our crowdfunding network. Okay, so it's not playing in the wild, wild west of AngelList and Gust and all that crap. I think those models are fraught with danger because people are going to lose 25 grand in 3 months on some bubble deal, and they're going to start suing the heck out of them. When you go into Always On and you're paying me $495 a month to see our qualified deal flow, you're only going to see great companies that have already gotten Benchmark and other good institutional investors as a play. Okay, so that's my pitch. Before I get into some entrepreneurial, 2 more slides. Is there any questions?
So this crowdfunding thing, there was a question earlier here. The big question is what's the role of crowdfunding going to be in this Silicon Valley ecosystem? Is it going to be disruptive of venture capital, or is it simply going to be additive to venture capital? What's your read on that?
Well, I think that the simple answer would be, I like Kickstarter. I think that's kind of cool to start, physical products that need, upfront, manufacturing financing. That's a lot of fun. I think AngelList and Gust, while I wouldn't want to be in their businesses, are certainly moving a lot of money around. And I'm a kind of guy, I'm an entrepreneur, so first I'm not an investor, so I like, hey, more money is good. Overfunding is good. Funding bad deals is okay with me because it doesn't, I'm not an investor. So I think all that money coming in is good on that front. I personally would be very fearful to be in the early stage, the angel market, because I think it's too much of the Wild Wild West. And it reminds me a little bit of the internet bubble days when the retail investors came in and drove the valuations of the public companies out of control because they weren't really sophisticated enough. Now, my model is to just list companies. So you'll have a company that'll have a profile, okay, like this, but there'll be a button that says invest in me. You'll click on it, and the only way you'll see a pop-up window if you're a high-price subscriber to our $495 a month. You'll be able to go into the exchange room and be able to sort and search through all the Silicon Valley companies. But they're all going to be always on filtered top companies that have frankly been referred to me by the top VCs to be awarded at all our events. So they're a highly filtered environment. A pop-up window will come up.
Tony, this
Yes.
has been such an exciting
Meredith, before you chop us off,
Are you giving me a look?
June, can we go just a couple of more minutes? I mean, we're going into a break, right?
Well, we need to give these people some time to
Okay.
speak.
Do you?
Okay, I'm sorry. Do you want to
Okay,
take a
June, is it
couple of
okay if we
questions?
just go a couple more minutes? Okay, thank you. Okay, thanks, Meredith.
Okay, so we're not going to get involved in transaction. We're just going to connect people all over the world to see a qualified deal flow. And my premise is that great companies have to go through 7 rounds of financing. The VCs will tell me, oh, well, if they're a good company, we'll keep funding them. Yeah, but what valuation? If these guys are asleep and they're getting solicited with electronic forms from the Saudi Arabian Wealth Fund who wants to give them a bunch of money and buy a bunch of their product, that CEO is going to be dancing in the street. So it's yet to be proven, but I just think it's time to crack Sand Hill Road open and use crowdfunding as a way to, open up that market for the benefit of entrepreneurs.
So then the flip side of that, which you touched on, is the risk of creating bubbles, right? So if you let all of this, flood of money come in, is there the danger that we create this whipsaw thing where all this money comes in thinking, there's an infinite amount of possibility for chasing the next big thing, but it bids up all these prices, and then we have a crash again. So is it possible that, that's the scenario that the $500 billion is going to create? Are you worried about that at all?
Well, I've already said that I'm an entrepreneur and I like overfunding. That doesn't bother me. I think more money is good for entrepreneurs. The second thing is to keep it in perspective, the internet bubble was a bubble in the public market. So when I wrote the book, there were 217 companies that had gone public. 85% weren't showing any profit. Okay, and you applied the Gurley formula to them, and they all would have had to grow 10 times faster than Cisco in order to earn their valuation. That was, to me, we'll never see that in the public market in my lifetime.
So we're not seeing, so the good news is...
And this is not about the public market. This is about overfunding really good companies. Now, the returns will go down, and, and it'll make being a venture capitalist a lot harder and maybe disrupt that model pretty dramatically, except for a handful of blue chip VCs that are really good at it. But there'll be strategic and corporate partners and governments getting in that aren't necessarily looking for venture capital returns.
So there's a flip side, even as an entrepreneur, I would argue, that as an entrepreneur, you don't necessarily want every grad student who can come up with a clever idea to compete with your company to get funded, right? I mean, so not only could it reduce the returns for investors, it could reduce the returns for entrepreneurs.
Well, I personally, I'm going to be the elite guy. I want to do only companies that have already been through, institutional screens of the top tier venture capitalists and whatnot. Like, I agree with you, at the angel funding level, that's the wild, wild west, and that's where a lot of wreckage will be and a lot of, ultimately, legal problems and craziness.
Okay, so how do you think Angel List will play out then?
Well, I mean, they're already trying to get into recruiting. They're already raised a venture fund themselves. I don't know. I can't even navigate that site. Does anybody navigate it very well? I mean, it's just such a pain in the ass, right? It's terrible. I don't know, but I like them because they got a really high valuation, and I'm about to raise my next round, and they're a comparable, so I like them for that. But I don't know, I just worry, and they've really pigeonholed themselves in the early stage market. Now, that being said, there's been a lot of great companies that got funded by them, so theoretically, I'm glad they've been around. Yes?
Yeah.
When you started out on an aside, you said we should all sign on to AO Networks.
Yes, yes.
For the audience here, which are mostly pre-angel funding.
Sorry, we're live streaming it.
You started by inviting us to join aonetworks.com. The question I have is for the audience here, where most of us are pre-angel, early angel, unfunded entrepreneurs, what would we find there of value to us today?
Okay, so thank you for asking that question. Well, first of all, our homepage, we have 100 industry bloggers, including Fred Wilson, Mark Cuban, Bill Gurley, Ben Horowitz. So if you want to go see the best blogging articles in our industry on the planet, you go to Always On every day, okay? Second of all, we do videos from our events. I'm going to do a couple of special programs. So it's very much about entrepreneurial education, boardroom level advice, hottest trends, meet the personalities. That's the media part. You will eventually, as we mature, be able to use it like you use Crunchbase. So when you hear of a company, you'll want to go to Always On first. It's not quite the case yet, but you'll go there to look at our profiles and the analytics that support them, because that'll be a much more nourishing experience. And then as you pay us money, you'll be able to find, the top 10 people on the planet that will be people you should know for whatever particular business that you're in through, it's like a Uber, LinkedIn for the global Silicon Valley. So there's research, there's news, there's education, all sorts of connect. Then once you find people, you can actually connect with them. Right? So we allow everybody to be able to connect and mail each other. We hope it's like a socialized Crunchbase to a large degree.
So join now, I can send you an email.
Exactly. So you can join now, connect with me, and then we can communicate.
Talk about wow, huh?
And you get more. No.
So we're here, but wait, there's more. So I know we are. I apologize, guys. We're running a little bit longer, but we'll just do a couple more questions, okay?
Quick one. So you're asking for $500 a month, so that's a lot of cup of noodles I can buy when I'm trying to build a company, right? So
how much did you say I'm asking for?
$495 a month, right?
No, that $495. 90%, 97% of our people will be for free. So you get a very nourishing experience for free. If you want to see the deal flow, like all the hot companies that come through our pipeline that are looking for money, then you have to pay us $495 a month. So that's the high-end product.
Right.
So I'm not expecting people that are looking for money to be paying to look at other people looking for money.
So if I don't pay it, I don't get a chance to get funded?
No, the funding part, oh yeah, then you give me lots of stock in your company, which is what I learned at Silicon Valley Bank. So I forgot to mention that for the companies that want to list on our exchange, first of all, they have to be approved by us. But once they're approved by us, then we give you the opportunity to give us either stock or cash as listing fees. So here's the story, and Jim Rutter's here and he'll verify this. I was the first commercial banker on the planet to take stock in exchange for loan fees, which was in Sybase, which ended up being a big relational database company, made the bank $15 million. As a result of that program that I created with H&Q when I was like 24, they have now 5,000 positions in 5,000 startups all over the world. So I always wanted to get back in that business, and I'm hoping to do it with this. Now, in a case of an early stage company, the chances are, unless you can get endorsements from VC Taskforce or Keiretsu or some other angel group that is taking you through some due diligence process, we're not going to allow you to necessarily, we'll leave that to the angel list. But I recommend angel list. I mean, I think if you can figure out how to play that game, I personally raised $280,000 on angel list. It wasn't the way I was supposed to. People said, oh, Tony's raising money, and then they sent me email, and then I went offline with them. So part of the thing I would say about crowdfunding is I think I'm not a big believer that sites can get in the middle of transactions, because then you have to be a broker-dealer, and I just don't think that's the way the world works. We're going to make our money by stock listing fees and higher subscriptions to access that deal flow. We're going to let them take those relationships offline and do what they normally got to do, if that makes sense.
So can I ask just a last question, and then we'll let you have a break, but I'm just curious, technically, where's the SEC line on kind of taking a listing? I get that media companies can publish, and there's no SEC issue, but if you take a listing fee, is there a line there anywhere? Have you cleared this with the lawyers?
Yeah, the quick answer is yes, and it's not. This vision would not be possible without the Jobs Act, and I'm not a lawyer, but what the Jobs Act says is it allows companies to more broadly solicit investment. So where I would have to become a broker-dealer is if I got involved in getting what you call success fees. So if I try to get in on the deal and say, oh, you raised $5 million on Always On, therefore I get 5% of that, or whatever. I can't do that. If I could do it, but I would have to become a broker-dealer. But our model is, for every 1,000 people that subscribe to our exchange, that's $6 million a year in free money.
So, well, with that, I just want to say what you heard it here first, gang, that what we used to think was new media is actually old media. It is toast. And now we have the rise of the new media. And I really appreciate your sharing that with us today.
And I would just like to close by saying, if you can pick any media market on the planet, and there's an opportunity to do the exact same thing. Okay, think of B2B. Think of I think the business of the entertainment world needs an always on. I think the business of the advertising world needs an always on. They will have different kind of social profiles and analytics and data to sell, but this brings the business model back to the media business, which pure and simple, other than being very loyal to Silicon Valley Bank, I'm also, want to give the media, let the media world take back what is lost, because I think there is still, room for good editorial judgment and quality presentation and design and all that kind of stuff.
Well, Tony, thanks. I hope you can hang around a little bit during the break here, but thank you so much for joining us. Appreciate it. Okay.
All right, guys. Thank you, guys. Thank you, Bill.